You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
Today's industry happenings will focus on Expiration Day. For years, Expiration Day has been the Saturday following the third Friday of the month. The third Friday was the last trading day of the expiration cycle. Unless it was a holiday, then Thursday was the last trading day. Expiration Day was always that Saturday. Now this February, that will all change. Expiration Day will actually be the third Friday. Investors will not be affected by the change, though. Much of the mechanics of expiration are operational and back office processes. In fact, many of these processes for the Friday expiration are already in place, and most have been employed for some time now. So officially, Expiration Day will be the third Friday starting this February. That's today's industry happenings.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Our guest today on Strategy Spotlight is Darren Tate of OCC's Investor Services Group. Good morning, Darren.
Good morning, Joe. How are you doing today?
I'm doing great. Hope you are as well.
Certainly are.
Very good. Before we get into today's strategy, back spreads, tell me a little bit what you do at Investor Services.
Well, Joe, we do a lot of things at Investor Services. Some of our main role is to answer the 888 options phone line, where we talk to a wide variety of investors, whether it be institutional investors or individual investors, and answer questions from very beginner individuals to much more advanced strategies, and incorporates a lot of different questions and concerns that we address there. We also spend some time answering customer emails. They can email us at options@theocc.com. There's also an online chat feature on our website, and we support that to answer customer questions via that method. We do support the website. We do all kinds of content review and update content for the optionseducation.org website.
And you do a heck of a job with that. Thanks for all you do there at Investor Services. You and the team really offer a fantastic service to the investors who are in the option space. Well, getting back to the idea of today's topic, back spreads. I think it's an interesting, topic. And why don't we start by you talking to our listeners about exactly what a back spread is and maybe why you decided to pick this strategy?
Yeah, absolutely, Joe. I agree with you 100%. I think back spreads are a very interesting trade. They are a fully hedged trade, so there is limited risk. It's a very directional trade at the same time, so the investor generally is looking for a big move in the underlying, whether it be a move much higher or a move much lower. Normally, a back spread consists of one short option and two long options, either done with all calls or all puts. These are the types of back spreads we'll be doing here. You could also modify the ratio to other ratios, 2x3 and that sort of stuff, but generally the long position is always going to be greater than the short position in terms of the number of contracts so that the position remains fully hedged. There are also situations where the investor can initiate the trade for maybe a credit, and so the move might not have to be as great for it to be profitable. And lastly, the expirations on the trade are going to be the same. So if we're looking at a March or a February or whatever expiration we're at, the expirations of the long and the short options are going to be the same, again, with the idea that the position remains fully hedged. I picked this strategy because it's a way to sort of take advantage of a big move in the underlying, generally speaking, sometimes without putting a lot of capital at risk. And we'll get into that as we discuss more further.
Well, why don't we, it's always about risk management when we're, talking about any investment. Why don't we, go through maybe an example of different strike prices and how these back spreads work?
Okay, sure. That's a great idea, Joe. Let's just say, for example, that the stock is currently trading. Maybe you got a particular security that you're really bullish on. Stock's currently maybe trading around, say, $50, and you're looking for maybe a nice move higher, maybe somewhere north of 60 or 70 or something like that.
That's a healthy move.
Right, for sure. A nice, healthy move. Hopefully make some nice profits up there. So let's just say that in this particular example that the $50 call, that you're going to short the $50 call, and let's just say that it's trading at $3, and then you're going to go out there and buy the two $55 calls, because remember, a back spread is one short option and two long options. So let's just say that the $55 calls are trading at $1 each, so they're going to cost you a total of $2. So you're going to sell the 50 for $3, and you're going to buy the two 55s at $1 each, so that's going to cost you $2. So you're actually going to be able to initiate this particular back spread for a credit of $1.
From a break-even standpoint, how do we look at that point?
Well, from a break-even standpoint, you really could go up to $51 and break even. And at expiration, you would have made or lost no money because of the dollar credit that you brought in. Now, and should you be wrong and the stock go lower, you would get to keep the dollar credit. So if everything was to expire worthless, it might not break your heart. You certainly didn't get the profits that you had maybe initially hoped for when you put on the trade, but at the same time, you brought in a dollar credit. So, and then to figure out where you're going to break even on a move higher, because the risk of the trade really is going to lie between 50 and 55. Well, in this case, really 51 and 55, because that's where you're going to start incurring losses on your short position before the hedge, if you will, of the long position starts to kick in, or before they start increasing in value. So that dollar credit, so you really have to look at where the stock is going to be in order to cover the difference between the strikes. So say, for example, the stock was to move to $60. Well, we know that the $50 call is worth $10. Now, that's bad because you're short that position, but the two $55 options are worth $5 each, so those are worth $10 collectively. So at $60, the trade essentially has no value, but you still brought in that dollar credit. So somewhere north of there is where you're now going to start incurring more profits, because the the $55 calls are increasing now 2 for 1, if you will, versus the $50 call. So on a move much higher is where the trade would certainly have its most value. So let's just say, for example, that the stock was to go up to $70. Well, at $70, we know that the $55 calls are worth $15 each. So that means a total of value of $30, where the $50 call is worth $20. So now you're at a position where you've got $10 worth of profit, and you also brought in the dollar credit. So your total profit at $70 underlying price would be the $11, the $10 difference between the total premiums plus the dollar credit that you brought in when you put on the trade.
Well, that is, really the point, I guess, really the primary focus with the back spreads is looking for, as you suggest, this big move in the underlying where your net long option, whether it's a call or a put, kicks in as the stock takes off significantly to the upside.
Right, and you can keep sort of doing the math, say you stress it all the way out to, say, $100 a share or something like that, and you can really start to see where the leverage that you're getting from the two longs versus the one short really starts to pay benefits.
Well, I don't know about you, but if I'm long 55 calls and the stock's, getting to 100, I'm out of that trade ages ago, unless it happened to be, a takeover and I got lucky. But, I understand the point. It's having those long options work for you.
Right, absolutely, and that's a real good point, Joe. Because taking those profits when they become available in some way, we're not all going to be able to hit those home runs, so to speak, with our trades. So, setting that exit strategy in mind to take those profits might not be as much profit as we all want, because we all want a lot of profit. But if you can take that profit at some point, because should you not elect to take the profit and loss, because certainly with the option markets, losses can come by quickly.
And just a little editorial from my point here, home runs for the most part, I think, are a function of luck more than anything. But that's for another day.
Absolutely.
What about picking, the strike prices? And, it's almost true for any option strategy, what month, what strike. But, is there any driving motivation to which strikes to do a back spread with?
Well, for sure, and that is one of the nice things about a back spread. As with really many option strategies, I suppose, the strike price selection can be tailored to meet a very wide variety of risk-reward characteristics. So the more risk one sort of wants to take, maybe the larger the difference between the short strike and the long strikes. Remember, we're short one strike, one lower strike on the call side, and two higher strike calls. So the greater the distance, back to that example, that 50-55. Now, if I spread that out to a 50-60 call spread instead of a 50-55 call spread, I'm going to increase. Remember, we said that was done for a dollar credit. So I'm going to increase that credit. I'm going to bring in, because this 55s are going to cost me less. But now I've got more exposure between the two strike prices, somewhere between 55 or 50 and plus that credit up to 60, that's where your risk is going to lie. So you really at $60 is probably going to be the worst case scenario. So you can sort of tailor that. Now, if I want to do the trade, I don't mind maybe initiating it for a debit. Now I can lower my strike prices, but at the expense of reduced profit potential.
Yeah, I'm sorry. I was just going to say, so really a function of maybe a couple things, how strong your opinion is on the underlying, as well as the combination of pricing.
Right, exactly. Yeah, exactly. How confident you are in your outlook. If I'm really confident that this thing is really going to take off, I may widen out that to bring in a greater credit and have more profit potential should there be a real big move. If I'm not as confident and I want to limit my exposure a little bit, I might come down. Now, again, I might have to pay for that trade versus bringing in a credit, but narrow down that strike difference with the idea that I'm not going to make as much, but I'm not going to have as great a risk between those two strikes either.
Well, something else you said that I want to get back to was, in your 50-60 example, the worst case scenario would be the stock at 60. And if you would just, again, emphasize for our listeners, the risk reward. I mean, we know if the stock takes off, we're net long options, whether it's calls or puts, we're gonna make, a good return. But that exposure to the loss, we as option investors don't want the underlying to be at the strike price at expiration. So would you go just emphasize that point, once again?
Right, exactly, and that's where, again, the risk of the trade, generally speaking, lies at that long strike price, because when I get to that long strike price, my short option remember, I'm only short one option versus two longs. So that short option is in the money by the most it can be in the money without my long positions doing me any good. So when I get to that, say I get to that in that 50-60 example, I get to $60, my short option has value of $10 at expiration. So that's where the maximum loss generally is going to occur, right around that threshold. Again, depending on whether it's done for a debit or a credit, but this is really where also the assignment risk comes into play. So investors that are doing this, whether it be with the calls or the puts, you certainly this trade does carry a lot of assignment risk, because especially the greater the distance between those strikes, because I'm not going to have the ability to exercise my long positions. I wouldn't want to do that. Say if the stock was at 60, there's no value there. So that might be a position too where the investor starts to think about exiting the trade prior to expiration if it doesn't look like that the move is going to be as great in the underlying. But certainly the risk of being, put stock in the case of the put spread, or being called away in the case of the call spread. And one thing we always like to throw out there when we're talking about assignment possibilities too is dividends, because we do find that exercise and a subsequent assignment activity occurs more frequently just before in the case of calls, or just after in the case of puts, a dividend just before or after an ex-dividend date.
Yeah, a couple great points there. Actually, I was going to ask you, do these trades typically get held to expiration? So I guess it depends on a number of factors. Can we walk through maybe, let's say we're short the 50s, long the 55s. There's a dividend upcoming prior to expiration. Can you walk through an example as to, what the likelihood of being assigned on that 50 call might be as we get close to expiration?
Absolutely, Joe, and that's a common question that we get at the help desk when we're talking to investors. One of the main things that you really want to look at there is the time value of the option versus the dividend. So let's say at the 50, we're short the $50 call. So let's say the stock was to go to 53, and let's just say for argument's sake that the option was trading at $3.50. So you got $3 of intrinsic value and 50 cents of time premium. And let's just say that the stock is going ex-dividend tomorrow, and it's going ex-dividend on a $1 dividend. Because the dividend is greater than the time value, that option is a characteristic of one that might get exercised and subsequently assigned to you. So that might be a situation where you decide to maybe close it out to avoid that, because the stock is likely going to decline by that dollar tomorrow anyway, and negatively impacting your long call options that are up there at the higher strike. But you might very well get called away. So you might want to manage that risk, when you're entering into any trade, and maybe back spreads also here certainly. You might look at when is it going ex-dividend? How much is the dividend? Because on that same example, if the dividend was maybe a 50-cent dividend, then it's sort of a wash. You might get assigned, you might not. It just sort of depends on where that option is trading and relative to the dividend and how much time value is left.
That's a great point. Well, back spreads, it's a strategy I know I used many, many times when I was down on the floor, and I think that out on the road, I'm not sure about yourself, but when I speak to investors, it's a strategy that comes up from time to time, not too often, but it does come, up from time to time. And I think you've laid out very, very well, the risks and benefits to the back spread strategy. And as you said at one point, this is a strategy that can be used with the same characteristics on both the call and the put side.
Right. And with the put back spread, still sticking with, say, the $50 stock price, but this time you think it's going to move lower, you would maybe short the $50 put, and here you would buy, say, 2 of the $45 puts. Now there you're looking for a move much lower. You do have still the risk between 50 and 45, much with the calls where we had the 50 to 55 risk. But you're really banking on a move much lower. But yeah, it is an interesting trade. I don't think a lot of investors fully understand it, and that's one of the reasons why I elected to discuss it today.
I think you laid out the points real clearly. Any final thoughts for our listeners?
Well, much like we talked about, Joe, I find it to be a very interesting trade. Typically, it can be done for, as we've said, very low cost, maybe even a credit, depending on where you structure your strikes and your expirations and so forth. Oftentimes, we like to point out how implied volatility changes can impact the trade, because that will certainly create profits or generate losses. Generally speaking, because your net long options here, you've got 2 longs versus 1 short, ideally the trade would be done when implied volatility levels were low, and when implied volatility levels are high, and you put on the trade, it could incur losses should implied volatility levels pull back, and you don't get that big move. Now, if you have a big move in the stock, implied volatility may changes in implied volatility may neutralize the impact. But it is an interesting trade. There's a lot of things to be concerned with when putting it on, the assignment risk we talked about, but always have that exit trade in mind, where you're going to limit your losses, where you're going to take profits, and more importantly, perhaps, is sticking to that exit trade.
Well, Darren, that last point on volatility, very, very important. Thanks for adding that. And I just want to thank you for joining us today on Strategy Spotlight.
Well, absolutely, Joe. I'm glad I can be here to help you out with this. And we certainly look forward to hearing to any listeners on the help desk. So feel free to give us a call, shoot us an email. We'll do our best to help you out.
And what's that number at the help desk?
888-OPTIONS. And the email is options@theocc.com. We look forward to hearing from you.
Thanks again, Darren.
You bet.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Bill Ryan, Managing Director at the New York Stock Exchange Options. Welcome, Bill.
Thanks, Joe. Pleasure to be here.
Tell our listeners, some of them probably know you as an OIC instructor. You do an awful lot of presentations across the country, but for those who don't know you, tell our listeners a little bit about your journey in this business.
Sure, Joe. I started back in 1982 with E.F. Hutton. I'm sure many of our older listeners will remember E.F. Hutton. And I've worked at several retail firms since that time, and recently as 10 years ago, went to work for the American Stock Exchange and now the New York Stock Exchange in the options business.
And when we talk about New York Stock Exchange and options, you've got a couple different exchanges. Just what about that?
Yeah, we have two options exchanges, NYSE ARCA. People be familiar with that years ago. That was the Peak Coast. And NYSE Amex, which was the old American Stock Exchange.
Now, word on the street is that you've got some new products coming down the pipeline. You want to, enlighten our listeners with what you got going?
Sure. The one that we're most happy with right now, we're excited to announce, is our relaunching of our binary option. Investors years ago may remember a fixed return option or a FRO, and that's coming back now as a binary return derivative or a BIRD.
What's that called again?
It's a binary return derivative, or otherwise known as a BIRD.
Okay, a BIRD. Now, how is a BIRD similar to a listed option?
Well, it's the same. Clears OCC. We have similar strike prices. We have weekly expirations, 100 multiplier. We trade in pennies. So it's a lot like a listed option, standard listed option, but in some ways it's different. Okay,
now you said weekly expirations. How often do you have an expiration?
Well, we'll have up to 5 weekly expirations listed. So our listeners that are familiar with standard expirations and weekly expirations will be familiar with these as weeklies. There'll be up to 5 weekly expirations for the BIRDs.
Okay, and then strike prices. Are the strike prices, as they are in a typical listed situation, right around the stock price?
Well, we'll take the underlying stock. We'll look at that. We'll look at the price where the underlying stock is trading, and we'll go up and down in dollars, probably 3 to 5 different strike prices.
Okay. Now, how are the BIRDs different from the standard listed option?
Well, they're different in that they pay a maximum of $100 per contract. So look at your standard options, and you have intrinsic value, and intrinsic value increases as the call option goes further in the money. The BIRDs will never increase above $100. And it's either a $100 payout or it's zero payout, and that's where the binary comes from. It's either all $100 or nothing, zero.
Okay, so that is a significant difference to the standard listed option.
It is a significant difference, and it settles a little differently. There's a thing called a VWAP, volume weighted average price, which is how we settle these options.
Okay, VWAP. Let's go through that. I think I've read a little bit about VWAP, and I think for our listeners, we should probably go through this, rather slowly. Talk to me about VWAP.
Right. So before we talk about VWAP, let me just explain that the BIRD, or the binary derivative, has limited risk and limited reward on both sides. So remember, it's limited risk, limited reward, and the reward is $100. The $100 is based on the BIRD being in the money. We have finished high BIRDs, we have finished low BIRDs, and we'll talk about them in a few minutes, I'm sure. But the settlement is based on the VWAP, and the VWAP is the volume-weighted average price. Now, it seems confusing, but we take all of the trades of a day, multiply those trades by the prices they trade, the shares by the prices, and then we divide by the total number of shares that trade that day, and that's how we get a volume-weighted average price. Now, it's important to understand that birds settle on the VWAP, not on the closing price of the stock.
Okay,
and that's the important part here.
That's critically important. Now, the VWAP calculation, is that done throughout the day so you have a sense of what the VWAP is? Is it only done at the close? How does that work?
It's done during the course of the day. And I'll give you an example of VWAP. If you had
that would be great.
Let's take a simple day. Let's take 2 trades. We have 200 shares traded $20. Do the math. 20 times 200 is 4,000. We have 300 shares traded 21. That's $6,300. You add them both together, that's 500 shares for a value of $10,300. Divide 10,300 by the 500 shares that traded that day. We have a VWAP of $20.60.
Okay, $20.60 theoretically at the end of the day is the value of the VWAP. And so all trades that take place over the course of the day are calculated into this VWAP, correct?
Yeah, this starts with the opening trade and continues to the close. So the VWAP is constantly being calculated. It's being disseminated every 15 seconds during the trading day.
And how is it disseminated?
It's disseminated over the regular tape using the bird symbol.
Okay, very good.
We can get into the bird symbol now or later on, Joe, whatever you'd like to do.
Talk to me. How do people recognize, that a bird is a bird?
Well,
a high bird or a low bird?
Birds will end with a Q. Right now we have them designed to end with a Q. The symbol will be similar to the underlying stock. So if you had XYZ, you might have XYQ. And that's not to say that any stock that ends in a Q is a bird, but all birds will end in a Q.
Okay. So as we go through the course of the day, the VWAP is being calculated, and then the options basically are trading. The birds are trading at the various strikes around that VWAP price.
And Joe, that's where the bird is similar to a standard listed option. It'll trade, on a listed exchange. It'll trade in a crowd. It'll trade electronically. We have market makers and specialists making markets in them, and they trade constantly during the course of the day.
Now, you said that the risk component, the max value is $1. Talk to me a little bit about. I guess it's pretty straightforward. Maximum risk, maximum reward.
Well, it is straightforward. The most you can lose with a long bird, if you buy either the finish high or the finish low, is the amount that you pay for the bird. Of course, including commissions. So, we're not talking about commissions right now, but the most you can lose is what you pay for that bird. That's on the long side. The most you can make then would be $100 minus what you've paid for that bird. So if you can make $100 and you paid $80, you've made $20. So the most you can make is the difference between $100 and what you've paid for that bird. The most you can lose is what you pay for the bird.
Okay.
That's on the long side. Now, on the short side, the most you can lose is $100 less any premium you've brought in. Remember, bird has a maximum settlement value of $100. It's not like a standard option where we have, constantly increasing intrinsic value. So once the bird reaches its maximum of 100, that's the most you can lose. So if you sell a bird for 80 cents or $80 per contract, the most you can lose is 20. Which would be $100 maximum value of the bird minus the 80 that you brought in when you sold that bird.
Okay, that's clear. Let's go through another example, if you don't mind. Let's go back to the VWAP at 2060. So if I bought the 21, and you talked about high bird, low bird, let's say I bought the 21 strike.
Okay, so let's first talk about finish high and finish low.
Okay.
Finish high can be looked at as similar to being a call. That's something you buy the finish high if you expect the VWAP to be above the strike price by expiration. So kind of like a call. You think the stock is going to be above the strike price at expiration. You buy a call. You would buy here. You buy the finish high bird. So our example of VWAP of $20.60, if you bought the 20 strike price finish high, that would be in the money at expiration because the VWAP is at $20.60, and you would be paid $100. If it closed at $20.01 on expiration, you would still be paid $100. So in the money is $100, whether it's in the money by a penny or in the money by $5. It's still a $100 maximum payout.
Okay, that helps me to understand this. That's good. How about when we compare, a regular call to, say, the finish high? How does that work?
Well, here's something that listeners have to be very aware of. At expiration, it's possible for the VWAP to be different from the closing price of the underlying stock.
And likely.
Most
right?
likely it will be different, yes.
Yeah, now say that again, just so listeners get that.
Right. The VWAP will most likely be different than the closing price of the underlying stock.
And VWAP stands for?
Volume weighted average price.
Over the course of a day.
Over the course of the day.
Okay.
And settlement is based on that VWAP on expiration day.
Okay.
So, for example, we have a VWAP of 2060. Our stock may have closed at $21. It may have closed at $20.50. So you could have a situation at expiration where the finish high is in the money, but the standard listed call option is out of the money, or vice versa. So it's very important that investors who use birds are aware that the VWAP is what your profit and loss is based on.
I'm glad you emphasized that, because that is in the money or out of the money based on VWAP.
Yep, absolutely.
Okay. I hope our listeners got that. Anything else on the bird, or shall we wrap it up?
Well, let's just talk about the finish low for a second.
Okay.
The finish low is similar to the put option. If you thought the stock was going to be down below the strike price, you would buy the put option or you'd buy the finish low bird.
So in our 2060 example,
the 21 strike price would be in the money and again would pay $100.
Okay. Very good, Bill. Before we wrap, anything else you want to offer to our listeners?
Sure. The first thing, we'll talk about the birds again. I can't emphasize enough the VWAP. Pay attention to that VWAP. The underlying stock at expiration may be different than the VWAP. Very important that they know that.
And if I may, where can listeners go to find out information on the product?
Well, they can come to our website. Go to our website, www.nyse.com. They can come there.
All right. Well, it's always good to have you. Any finishing thoughts?
Sure. Again, pay attention to the VWAP. And as I always say when we talk about the option world, make sure you understand the product that you're trading. Make sure you understand your risk and reward. Check with your tax advisor for any tax situations. And if you have any questions, call your financial advisor and ask their opinion.
Fantastic, Bill. Well, great to see you as always. And I'm sure our listeners, who have a chance to see you in person are happy to hear you on the radio program today.
Thank you.
You're welcome.
Take care, Joe.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, we'll take a look at what I consider to be one of the main drivers for options growth and tighter markets in the options industry over the past 15 years. August 18th, 1999, right in the middle of the tech bubble, the SIBO and Amex dual-listed options on Dell Computer, which up until then had only been available on the PHLX. The PHLX responded by listing options on Coke, IBM, and Johnson & Johnson, which until then had only been traded on the SIBO. PHLX also listed Apple options, which had traded on the Amex. Now, by September of '99, according to a study by Patrick DeFontenot, Richard Fisk, and Jeffrey Harris in the Journal of Investment Management, more than 60% of all industry volume had shifted to the 130 or so multiply listed products. The Pacific Coast Options Exchange also entered the multiple listing battle that summer. Now, the study also found bid-offer spreads decreased by over 30% from pre-multiple listing levels. Pricing competition clearly changed the industry for good in that summer of 1999. That's today's Looking Back.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.